Welcome to This Explainer. Today, we're unpacking the absolute dream, sipping coffee in your pajamas on a Tuesday morning while a cool $1,000 in passive income just magically lands in your bank account. I mean, no overtime required, no side hustles to manage, just pure passive income generated by companies sharing their hard-earned profits directly with you. Now, I know it sounds almost too good to be true, doesn't it? But today we're going to break down the exact real-world mathematics of how this actually works. Okay, let's just dive right into the main question here. Exactly how much money do you need to invest to make this dream a reality? And do it without resorting to some sketchy get-rich-quick scheme. We are totally leaving the financial fantasies at the door today. Instead, we're looking strictly at the numbers, the proven strategies, and the real-world capital you actually need to build a portfolio that pays your bills. So, to hit that $1,000 a month, what we're really targeting here is 12 grand a year in passive income. Honestly, when you zoom out to that annual view, it just gives us a much clearer target to build our whole mathematical framework around. And to get there, to figure out the exact size of the portfolio we need, we have to understand one absolutely crucial metric that dictates this entire journey. And that crucial point is understanding dividend yield. It acts a lot like basic bank interest, except you're getting paid by real companies just for owning a tiny piece of their business. Think about it. If you put money in a savings account with a 2% interest rate, you know exactly what you're going to get back. Well, dividend yields operate on that exact same basic math. But instead of settling for boring bank interest, you are literally sharing in the profits of massive global businesses.
But wait, this brings up a massive trap. When you see Company B offering a whopping 12% yield compared to Company A's 3%, your first instinct is probably to jump straight at the bigger number. I mean, that's 4 times the money, right? But in the investing world, chasing that high yield is so often like chasing fool's gold. It's like shopping a clearance sale where the high yield actually just signals a struggling company. A sky-high yield usually means the company's stock price has plummeted, or they're paying out cash they simply can't afford. Those generous 12% payments, they can literally disappear overnight. And we want sustainable wealth here, not a gamble.
So let's move into our first section, the reality check. We're going to look at the math of safe investing.
Now that we know we should target a safe, conservative yield of around 3 to 5%, it is time to face the steep mountain climb of the actual math. This is where we separate the serious investors from the daydreamers, folks. Brace yourselves, because at a 3% yield, you need an eye-watering $400,000 invested to generate that 12 grand annually. That is more than most people's houses are worth. I know, that number might make you want to just tune out and go do something else. It's a massive amount of capital. But remember, this is for a boring, reliable, sleep-well-at-night portfolio made up of incredibly stable companies.
If you look at the different foundational strategies out there, you'll see that opting for a balanced market approach or pure growth requires even more capital up front. It really shifts the focus from immediate income to long-term value. For example, a growth fund might only pay 0.5% in dividends, which means you need $2.5 million just to get your $1,000 a month. No way. So comparatively, targeting a conservative 3% dividend strategy is actually the most direct and efficient path to purely passive cash flow.
Up next, Section 2, Alternate Routes, or as I like to call them, the spicy high-yield approaches.
Let's be real for a second. If you don't want to wait decades to build up 400 grand, there are some specialized, spicy routes that require less capital, but they definitely come with significant risks. We absolutely have to explore these because they're incredibly popular, but you're going to have to navigate some treacherous financial waters. You actually could hit your goal with $150,000 to $300,000 by betting heavily on energy, acting as a landlord through REITs, or picking individual stocks. But listen, these are roller coaster rides. Energy markets fluctuate wildly with oil prices. REITs, those are real estate investment trusts, are super sensitive to interest rates in the broader economy. And individual stocks, you're putting all your faith in a handful of management teams. It's incredibly tempting because it requires less cash, but you are absolutely trading financial safety for speed.
Which brings us to Section 3, the climbing gear. We're talking sustainability and reinvestment. This is the core strategy used by the pros. Rather than gambling on risky sectors, successful investors focus heavily on the sustainability of the income. They make sure their money partners are reliable for the long haul. You're basically entering into a decades-long relationship with these businesses. These companies, we're talking heavyweights like Coca-Cola or Johnson & Johnson, might only yield 2.5 to 3%, but their payouts are as reliable as gravity. And the best part? They actually increase over time. They've survived recessions, market crashes, and massive economic shifts without ever cutting their payouts. In fact, they raise them. It's literally the equivalent of getting an automatic annual raise without ever having to ask your boss. So how do you actually buy enough of them? Well, the good news is you don't need the $400,000 tomorrow. You build it gradually using dollar-cost averaging. You let time and compound growth act as a giant financial snowball rolling toward your retirement. You just start with $500 or $1,000 a month. Over time, your capital grows, but more importantly, the dividends those companies pay you buy even more shares, which then pay you even more dividends. It's brilliant!
Let's really think about how this snowball effect actually builds. Even without adding new money, reinvesting a $50,000 portfolio's dividends over 20 years ruthlessly works the mathematics in your favor. Year 1 is a modest $1,500, but by year 20, simply by reinvesting, without adding another dime of your own capital, by the way, your portfolio is approaching 90 grand and generating $2,700 a year. Now, imagine combining this natural snowball with your regular monthly contributions. Suddenly, that $400,000 mountain looks very, very climbable.
But there is a catch. The single biggest mistake people make is spending those early, tiny dividends instead of reinvesting them. You're essentially eating the seeds instead of letting your money go out there and make more money. When you get that very first $50 dividend check, it is so tempting to just blow it on takeout, but you have to resist. Reinvesting is the closest thing to actual magic in the financial world.
All right, before we wrap up Section 4, Weathering the Elements, we need to talk about taxes and total return.
As we hit the peak of our explainer today, we absolutely have to address the hidden obstacles on this mountain, the tax bite, and alternative wealth-building strategies. Ignoring these elements, yeah, that's a recipe for a rude awakening. We all love talking about the income, but we kind of hate talking about the taxes, right? But the stark reality of tax drag is severe. Unless you use tax-advantaged accounts like IRAs, Uncle Sam's cut means you actually need to generate $1,300 gross just to net your $1,000 target. If you hold these stocks in a standard brokerage account, you're going to lose a serious chunk of that cash flow. Utilizing a tax-advantaged account like a Roth IRA allows those dividends to compound and land right in your pocket without that severe annual tax drag. Finally, we really need to consider the total return perspective. Instead of needing $400,000 for pure dividends, you might only need $200,000 in fast-growing investments, selling small portions occasionally to create that exact same $1,000 a month. This is the great debate in finance. Companies that pay high dividends are handing you cash instead of reinvesting it to grow their own business. If you focus on younger, fast-growing companies that reinvest in themselves, your portfolio balance might explode much, much faster. It's a mathematically sound approach for sure, but you do trade away the sheer psychological comfort of a steady, automatic dividend check hitting your account every month.
Which brings us to the end of our journey today. While the psychological thrill of getting paid for literally doing nothing is incredibly powerful, the real question is whether you'll start your journey today. Because every single dividend aristocrat out there started as someone's very first stock purchase. The math of building $1,000 a month is crystal clear. It takes patience, consistency, and a total refusal to chase fool's gold. The only unknown variable left in this equation is you. Thanks so much for joining me for this explainer, and I really hope it gave you the clarity to start planting those seeds today.